In April 2025, a bold move by the Trump administration shocked global markets. The U.S. imposed a staggering 39% tariff on imports of Swiss gold bars, which was expected to have far-reaching consequences for the global gold market. This tariff wasn't just another trade dispute. It was a high-stakes move that would test the United States' economic influence, Switzerland's gold refining dominance, and the stability of the international financial system. 1. Trump's high-stakes gold tariff play, the U.S. and Switzerland in a dangerous game. In the spring of 2025, the U.S. administration announced its plan to impose a massive 39% tariff on a wide array of Swiss imports, including gold. Initially, gold was thought to be exempt due to its role in U.S. reserve management. However, U.S. trade hawks saw an opportunity to challenge Switzerland's dominance in the global gold refining market. Switzerland refines nearly 70% of the world's gold, a process that is critical for central banks worldwide, including the Federal Reserve, to maintain reserve quality. Switzerland has long been the hub for the global gold trade, with its refineries producing high-purity gold bars that meet the stringent standards for central bank reserves. For decades, these refineries had maintained a symbiotic relationship with the U.S. government, ensuring the Fed's reserves were of the highest quality. However, the tariff announcement in April 2025 set the stage for an economic showdown. By July 31st, tensions had escalated. The U.S. customs ruling meant that Swiss 1 kilogram and 1 ounce gold bars, the standard used by the COMEX market, would be subject to the new tariffs. In response, the price of gold futures surged to a record $3,534 per ounce, a dramatic reaction that signaled the volatility of the situation. The Swiss president, Karin Keller-Sutter, rushed to Washington in a last-ditch effort to appeal to the U.S. government, but her plea was rejected. It wasn't until President Trump made an unexpected announcement on social media that the tariffs on Swiss gold were scrapped. The market responded quickly, with gold prices retreating to $3,407 per ounce. This sudden reversal of the tariff decision left the markets reeling, but it also had larger implications for global trade, monetary policy, and economic stability. 2. Swiss gold, the unreplaceable engine of the global economy. Swiss gold refining isn't just a matter of historical significance, it's a cornerstone of the global economy. While other countries like Canada and Australia have some refining capabilities, they can't match Switzerland's throughput or consistency. The precision required to produce the highest quality gold bars necessary for central banks is unmatched by any other nation. Japan's refineries, for instance, face domestic demand and logistical challenges that make scaling up to match Swiss standards nearly impossible. Beyond the technicality of refining, Swiss gold holds symbolic importance. In the first quarter of 2025, Switzerland exported a staggering $36 billion in gold, accounting for 2/3 of the country's trade surplus with the U.S. This dominance not only grants Switzerland enormous economic leverage, but also underscores its integral role in the global financial system. Should the tariff continue to be enforced, the disruption in gold supplies would not only affect traders, but also industries ranging from luxury watches to high-tech manufacturing, industries that rely on precision and stability. Hallmarks of the Swiss economy. The ripple effect on the U.S. economy. A paradox for Trump's deficit-cutting agenda. On the surface, a 39% tariff on Swiss gold may seem like a trivial concern when compared to the U.S. trade deficit, which stood at $48 billion in early 2025. However, gold's role in financial markets is far more influential than its raw cost suggests. Gold prices directly influence the Federal Reserve's reserve management, liquidity buffers, bond yields, and even the dollar's strength. A $15 increase in the gold premium can impact bond yields by as much as 20 basis points, strengthening the dollar but also making U.S. exports more expensive. This presents a paradox for Trump's deficit-cutting strategy. The tariff could raise borrowing costs, ultimately undermining the goal of reducing the U.S. trade deficit. In addition to the economic effects, there were political divides. On one side, Utah's mining lobby pushed for stricter origin certification to bolster domestic supply. On the other hand, jewelers in New Jersey and Illinois lobbied for exemptions to mitigate the increased costs. The tariff decision became a political hot potato, and a few swing votes in Congress could tip the balance in favor of either side. The economic implications were already being felt, with banks like UBS warning that higher premiums could strengthen the Swiss franc, while JP Morgan suggested that the Federal Reserve might have to inject up to $75 billion into the repo market to stabilize the economy. This costly intervention would counteract the president's broader fiscal goals. Fourth, Switzerland's leverage, a tactical counterpunch. Switzerland, though, wasn't just waiting for the storm to pass. Swiss officials were already plotting their countermeasures. By connecting the gold tariff dispute to its broader range of high-value exports, such as pharmaceuticals, luxury watches, and precision instruments, Switzerland turned the gold dispute into a multi-front negotiation. Swiss negotiators hinted that any relief on the gold tariff could be tied to easing pharmaceutical quotas or reducing duties on industrial components. However, there was one issue that Switzerland was unwilling to compromise on: banking secrecy. Swiss banking laws, enshrined in constitutional law and supported by strong public opinion, are fiercely protected, even at the cost of major concessions. 5. The endgame, a deal or deadlock. Both Washington and Bern, the capital of Switzerland, knew that dragging out this standoff could have devastating consequences for their respective economies. The U.S. could face higher gold premiums, escalating borrowing costs, and a loss of credibility in its reserves. Meanwhile, Switzerland stood to lose a significant portion of its revenue and would have to reconsider its export model if it lost access to the U.S. market. A potential compromise was on the table. Switzerland could agree to partial transparency in exchange for tariff relief. This would involve Switzerland offering limited access to financial data in exchange for reduced tariffs. Such a deal could reduce the trade deficit by $4 to $5 billion and help stabilize the gold premium. However, even this agreement would come at a cost: additional logistics, insurance, and compliance expenses that could increase the gold price by $2 to $3 per ounce. At the heart of this conflict is a question of power. Can Switzerland afford to lose its financial independence? Or has the global landscape shifted so much that Switzerland's prized neutrality and secrecy have become liabilities? Final verdict: gold's geopolitical showdown. What started as a minor tax dispute between two nations spiraled into a high-stakes geopolitical showdown. The 39% tariff on Swiss gold bars exposed the delicate balance between economic power, financial stability, and trade dominance. Whether the U.S. will compromise on Swiss gold, or whether Switzerland will find a way to leverage its gold dominance further, remains to be seen. This conflict could ultimately reshape not only global trade, but also the way the world views America's fiscal discipline and reserve management. With global markets hanging on every word from U.S.-Swiss talks, this geopolitical race could continue to have long-lasting ramifications. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.